So perhaps there was a big adjustment required from bonds and treasuries for that reason. So when you look at the bonds in terms of their tips coming into today, there was a massive need to buy bonds, wasn't there? Look at the tips markets. Look how discounted they are against these previous balance areas. So when you see this on a macro scale, and this reminds us to always check back in on the macros. This reminds us to always check back in on the macros, because if you look at the macro, what direction do you think bonds are going to go at the open? There's been a lot of selling of tips against US Treasuries. So coming into the open of the US bond session, there's a huge desire to buy bonds, isn't there? There's got to be a huge appetite to buy bonds on a macro scale. If you're selling tips against treasuries, what does that mean? That means lower inflation. Now, obviously, if you're looking at a lower inflation market on a macro scale, that's the first thing the US guys are seeing. Okay? The first thing the US guys are seeing aren't the US tips markets, because nobody's dealing any business on those at this stage. So the first thing that the US guys see at 1 o'clock when they come in is the bid that's required from treasuries because of the amount of inflation that the tips markets are showing. So obviously one of the things that you have to wait for is you won't have to wait for that tips to show us what the real level is going to be. Are we going to go above the bond price, or are we going to stay below the bond price today? That's a big question. So when you understand that this is massively discounted against bonds, you know there's an upside at the US Open, right? Does that make sense to everybody that trades bonds? Every day you come into the US Open, you're going to be trying to understand what they're seeing at the start of their day. So when the market ripped higher, it was okay because we were buying bonds. I was starting to unwind my long position, and I was looking at the possibility of selling into the US Open. Well, that's what I did. I sold the US Open. I started to offer into the US Open. So the market was strongly bid on the tips markets because of the very sizable divergence. And when you look at that, you're saying, okay, well, what does that tell me? That tells us we have a very strong piece of evidence for lower inflation. But is that right? Is that right? Well, we have to then check to see what oil's doing, don't we? If I do 1 over oil should be, obviously, if you're looking at oil itself, I'll change it to I'll just change it to oil so that we get rid of the 1 over oil, and so that you can understand the oil relationship to inflation. Remember, if the tips market's lower, that suggests lower inflation. That suggests lower inflation. So when we look at oil prices, what were oil prices doing from when the tips markets closed from the day before? Do you think the tips markets look realistic at these prices? Remember, tips are still bonds. They are still a negative correlation, remember that. Tips are still bonds. So you can't look at tips against oil because they'll always be negatively correlated, always. The only thing you can do is look at tips against bonds and oil. So when I look at the tips markets, I'm looking at the tips market saying, okay, the tips are underpriced against bonds. That suggests there's lower inflation. And yet when we came into the when we came into the London session, oil prices were at top edges. Well, that's all wrong. Surely that's all wrong. It's got to be wrong. So either the oil price is massively overpriced, or there's going to be a massive surge in buying in the tips auctions, right? It's going to be a massive surge in buying on tips. So when does that buying start showing up? Well, we would obviously wait to see the big volume on the treasury bond market. So you'd imagine you'd see that massive buying on tips or the massive selling on bonds at about 1 o'clock. What happened at 1 o'clock? We got the big rip on the tips markets. We got a big upside rip. Exactly as you would have probably expected to get. So it's no longer a surprise that we got the rip, and that's why we were very, very patient about selling some treasuries. Now, in line with that, of course, you could have sold some oil against the tips ripping higher, which would have been a great hedge trade to be in these two elements and try and take advantage, because the tips against bonds, you could have bought tips and sold bonds and then sold oil against it. If I'm buying tips and selling bonds, then obviously I'm long inflation. If I'm long inflation but short oil, surely I've got a brilliant trade. Surely I've got a brilliant trade opportunity to do business here. Well, that's exactly my point. We do have a brilliant trade opportunity. That was that buy trade. Now, what happens next? Well, we don't know. We're going to have to wait and see. But coming back into the high price, one of the things I can see from the high price at the moment, now this is before the US tips markets get started, and we'll have to do a revaluation when the US tips markets get started, of course. But what I can see is the bonds back at the top edge, the tips are discounted marginally. The tips are discounted from the last time we were in this area. There's the discount on the tips markets. What does that gap tell me? The tips markets are still trading at a discount to bonds, and as a result, either there's a mispricing of oil and equities at top edges, and therefore oil and equities will probably be selling, or there's still a mispricing on the tips markets. There's still a mispricing on the tips. The tips need to go higher, and obviously that's going to be confirmation that the inflation is still visible. And if the inflation is still visible, then of course we would expect the oil price to carry on through the top edges, and would expect the equity price to carry on through the top edges at that stage. So this is something we want to try and do. We want to make sure we don't lose sight of how out of price these things are. Remember, if tips are below bonds, oil should be falling. If tips get above bonds, oil should be rising. And we can look at it on a macro scale basis. Now, this isn't as accurate because this obviously also builds in the euro dollar, because this isn't US tips, remember. The US tips are going to be far more accurate in this assessment, but it's all we've got at this time of the day, right? It's all we've got, because obviously when we're looking at inflation, we're looking at US inflation when we trade US Treasury bonds. So this is never going to be the most accurate picture that we can build. The most accurate picture will be available to us at 2:30. And that's when we can really go to town on whether this is underpriced or overpriced or in between priced or whatever. We can go to town on that trade at that stage. But until that happens, there really isn't an opportunity for me to do an awful lot with this until this settles. So obviously we want to lean against the Japanese yen, we want to lean against the Swiss franc, we want to lean against the absolutes, and we want to get those kind of trade elements out of the way first, and we want to make sure we understand what's going on. If anybody did the, I said I would bring the dollar gold spread trade in as it developed and as it evolved this afternoon. I wanted to show you where we're at just now with that spread trade. And here is the trade here. If you remember, I said to everybody, we'll bring this in as the afternoon progresses. You can see we built a little bit of a spread here on the euro, and we built a little bit of a spread here on gold. You can see we're short euros, we're long gold, and you can see we've got 10 spreads, 14 spreads, and we've got about $800. So it's not quite $100 a spread. But it's not a bad outcome. Actually, it's just went 500, 500 now. So we've actually got our $1,000 a spread now, guys. It's went 500, 500. It's almost a perfect spread outcome, isn't it? So that's what we've now got. You'll see that it's just went 500, 500. So the two spreads together, the total spread is 10 contracts. The two spreads together now $1,000. That's us got the $100 per spread outcome. And that's what we normally target, isn't it? That $100 spread outcome. Pretty good. It's amazing how these types of ideas, for whatever reason, still seem to be difficult for people to kind of grasp. I've taken a trade, not the best prices, nowhere near the best prices. I just wanted to show everybody what the spread was. I took a trade for the spread myself, but when I thought about it, it still had value when I was talking to the guys in the room, and I said to Paul, I said, I'll put the spread on and we'll look at it later on. We'll take a look at it later on as the trade evolves. And that's what we did. We just did exactly that. We just took the spread. At the time I said I was taking the spread. I said I would show it later on, and I will obviously target, we're always targeting $100 for the spread price, $100 for the spread price. And now I've got a choice. I can either leave the gold longs in place or the short euros in place. I can choose to close out one of these two trades for $500 profit. I can put the other one into break evens, and I might make $5,000 profit. I might make $10,000 profit. I might make $1 profit. But this is what the trade is. This is what the trade is. We're just trying to build a bit of a spread around the volatility, the ratio, and the trade outcome. And I quite liked a little bit more euros than gold. Gold's always a lot more volatile. So, but gold this morning hasn't been that volatile. Personally, I've seen quite a quiet inside kind of gold market today. So the gold volatility's dropped right off. And if you look at gold, you'll see that that's actually the truth. If you look at gold itself, the volatility is almost zero. It's so flat, it's so quiet, it's deathly silence in this gold market just now. So, you know, for me, it's a lower volatility play, so I'm quite happy to do 14 by 10s at the moment, 14 by 10s. Now, what I've ended up doing actually is I closed off the euro trade for 500 and I've left the gold trade in place. So I closed off the euro trade because I felt that the gold was likely to go higher, and I left the I closed off the euro trade for about $500, and the gold has gone higher. The gold's now up at 1,400 odd bucks, and I'm now making a total on the spread. I'm now making a lot more money in terms of the spread profit, because obviously I've added the $1,300 to the $500 that I closed on the euro, and here's the trade now. So there's the gold. It's now up $1,300. And that just gives you an idea of how you can ultimately evolve the trade if you want to. You've now closed that position off and you've left this position open. And obviously, if that position takes off, it could potentially go to $10,000, $5,000, $2,000, $1,000, or whatever. But it's about building out that proposition, isn't it? It's always about building out the proposition that's in those trades and trying to figure out where the best way to maximize your opportunity is on those types of spreads, guys. We're into the cash open. We've bundled our way through into the cash open, guys. So let's see what the day's got for us. Exciting stuff. The oil's been desperate.